What's up, everybody? Just wanted to do a quick video on more so on just like how to think when investing. And as you can see on the screen, I have a chart of Apple, a weekly chart of Apple, and it's come a long way. And a lot of us that are in the markets probably didn't know about investing, or probably just too young about investing to have experienced or even seen prices in Apple back in early 2000, in the 90s, right? The number gets less and less of how many people have actually experienced investing into Apple over the years, right? And more so people that are just, I'd say, just more, uh, you see this price rise, and you're like, wow, it has come a long way. You're like, wow, man, that's a big move. If only, we always say, if only I would have bought, during the great financial crisis. If only, I bought back in early 2000. And, especially in the crypto space, a lot of investors are very new, probably a couple of years young, a lot of young traders, a lot of young investors in the market nowadays. And it's just hard to fathom what it was like during this time. Like, say, like I started trading in 2009, 2008. I was, I was looking at the market, but I didn't really know how to invest during that time, right? And I can tell you firsthand that during this time, there was a lot of fear. A lot of people just very scared. Um, people didn't even want to like touch investing. Everyone was thinking that the banks, everyone was just thinking the world was going to just implode, right? Like the whole financial sector was just going to come crashing down and create this huge collapse of the financial system. I mean, it was, you could feel the fear. It was very bad. And you know during that time, I there was people that I knew that were sitting there. They were older than me, right? Much older, and they were just sitting there every day. Like some of them were buying every single day. Not particularly like Apple, but like different stocks at the time, right? They had their own convictions in investments, and they're just buying more. And I'm sitting there just asking them like, man, things look terrible. Why would you be buying right now, right? And they're simply just saying it's on sale, right? And that kind of intrigued me and got me interested into the markets. And I've traded Apple, and during this time, you can see here on the screen, the price of Apple was $3, split adjusted at the time. So imagine getting Apple for $3, and now it's at $180, right? So imagine imagine having Apple at that time, and not only Apple, all the FANG stocks back then. You had Facebook, Google, Amazon, Netflix, right? They were all particularly like younger stocks at the time. They were very volatile, uh, similar to how crypto is nowadays, like Bitcoin, right? And the way I like to think of stocks is when they first launch, when they first IPO, or when they're just new in the market, they're like, it's like a baby being born, right? And babies are very volatile. They they need a lot of attention. They they make you want to pull your hair out at times. And over time, babies, eventually mature, they turn into kids, and then they go into adulthood, right? So I kind of think of that cycle the same way as I think of investing. And back then, Apple in like 2008, 2009, Apple was like a rock star type of like trading vehicle. Like it was like one of the top stocks to trade back then. It was so volatile, right? And since then, it's done a couple of splits. I think two splits, if I'm not mistaken, maybe three. I don't know. I can't remember, but every time it's done a split, what happens is more stock floods the market, right? It dilutes the market. And the more stock that's out there, there's a lot more supply in in the market for Apple, so to speak, right? And what that does is it kind of tempers that price volatility. And as you see Apple nowadays, like I mean, look at the chart, from just look at it since 2022, the past couple of years. It's been in this 199 to like one 130 range, right? Just like in this price range here. Not as volatile as it was like say back here, or how it's had its run since 2008 from $3 split adjusted. And in the matter of just a few years, you know, it in it like 8x, you know? That's a that's why I'm saying it was like a crazy. It was one of the best trading investment vehicles. And then you just throw in options with Apple at the time. Apple trading options with Apple was insane. And I've been there and I've traded options on Apple, and uh, the moves were just incredible, especially during that time, right? I mean, look at this. It's just straight up. That's it. You felt like a genius. You just bought and held, and everything just went up. It was crazy, right? Crazy times. Now I'm thinking of Apple after it's split a couple times. It's starting to get more mature. It's not as volatile, right? It's becoming more people are willing to hold it long term, are not willing to sell it at every single, knee jerk reaction. And that's what I mean by like how it's maturing. If you look at stocks like say Johnson and Johnson, Coca-Cola, right? These dividend aristocrat stocks, they don't move much in price, right? Because people at that stage is kind of like an old wise man, right? Not very volatile, moves slow, and just has a lot of experience, right? And people sit there and hold a stock like those dividend aristocrats with a different type of mindset, right? They're looking to just collect that dividend income, right? So they're willing to hold the stock. So that creates less volatility in its price. So if you look at like a stock like Bitcoin, right? Or sorry, that's not a stock, but if you look at Bitcoin, and for those that have been in the crypto space for years, it started out. It used to be very volatile, right? And into like today's price action, yes, it's still very volatile, but for those that have seen Bitcoin being volatile over the past few years or several years, you know, you can see that path it's taken to maturity, right? And that's just something to think about. Like we often get hung up on like the short-term price volatility. Like say with Bitcoin, right? It's just constantly volatile. It hit 73K like just a month ago, a little over a month ago. Now it's down, down into 50Ks. Well, it's probably over 60K right now as I speak. But a lot of people look at investments very short term, and they see, especially if they don't have a plan, they see they have a short term thinking. They easily get scared out of positions. They sell when they shouldn't. They buy when they shouldn't, right? And in my experience, back in 2008, 2009, when I was trading stocks like Apple, Facebook, I remember I had Facebook at like $20, right? I had Google when it was triple digits, Amazon, same thing, Netflix, and throughout my years, I've traded the markets. I've learned a lot of hard lessons, but the one big hard lesson I've learned was if there's if there's an asset that you wouldn't mind holding long term, that is a good company, great fundamentals, it's just fundamentally sound. Yes, you could have like your trading account, but you should also have your long term account. It's very important to have a long term account that you invest in monthly. You throw in monthly flows into it, and it automatically invests into the assets that you want to hold long term, and you just don't touch them. Maybe you touch them if something happened or something changes fundamentally with the individual investment, right? But other than that, you just hold them long term, right? And just thinking that, wow, if I would have just held Apple, Microsoft, Google, Facebook, Netflix, if I would have just bought them all back here and not have traded this whole time and used my time elsewhere, right? Because I've spent a lot of my time learning about trading, learning about different products, investment vehicles like options, futures, selling options, right? Stocks, day trading, swing trading, all, throughout the years, I just, immersed myself into learning this stuff, right? And just thinking like, wow, what if I just took my money and, invested into these stocks back in '08, '09, and then every month I invested into them, as I uh, deposited my monthly flows into them, right? Where would I be today? And, you know, I think about this often. I'm just like, man, like how much time would I have saved and how much more money I would have made? And where could I have used that time? You know, could I have used it uh, chasing some other venture, right? Or finding another way to bring in more income, right? And this is a lesson that I've learned over the years. And it's kind of like, for some, I know like trading is like, something they want to chase and do, right? Because, it has there's this, there's this draw to it, right? That you can make a lot of money doing it, right? But you're also trading something to trade. You're trading your time for that money, right? So I mean, it's just an interesting thought to ponder and think what what can I do something better with my time? And honestly, like if for those new traders that are starting to trade and learning how to trade and have these aspirations, if your account balance isn't large enough to sustain or even like to create a living off of, like say if you can make 10% on your trading account and live off that 10% per year, right? Then I think that's large enough of an account to trade full time and live off of, right? But that's not the case for most people. Most people, they start out with a couple grand, 1,000, 10 grand. You know, it all depends where you live, honestly, but it's got to be a realistic. You got to analyze that realistically and just really determine, okay, what kind of percentage returns do I need to make on my account in order to live off of it and trade full time? Some people want to trade off, live off 10 grand, well, shit, like it's a lot easier to make 10% per year on 10 grand than it is to try to make 1,000%, right? To 10x that 10 grand. It's very tough. And I'm not sure where I'm going with this video, right? But it's just these are the things that we have to think about, right? And when it comes to like if you when it comes to investing, just going back to saying like it's okay to have a trading account to get that out of your system because you know a lot of us like to trade and it is a great way to make some extra income, right? But at the same time, just in case just in case you're not one of the traders that make it and can make consistent income off of it, or even worse, blow up your account multiple times, at least have a long-term investment account that you can fall back on. For instance, like say things go terribly wrong, you blow up 10 accounts, trading accounts over the course of 10 years, but you've been investing into your long-term account every month, putting in the monthly flows. And at the end of 10 years, you're like, you know what? I'm just going to hang it up. This is not working for me. Not everybody can be a trader, right? And that's okay. It doesn't have to be your thing. There's nothing wrong with you on that. You're built for something else, right? There's something else out there for you. And at that moment, you could be like, well, I gave it a shot. I gave it a fair shot. It's just not for me. So at least I have this investment account that I've been growing, and I'm glad I have that, right? Don't look back and make the mistake of, wow, I spent 10 years of my life, I spent all this money trying to trade and I threw it all away. I gambled it away, right? That would be the worst outcome. So, just like in the markets, you're always looking a way to hedge out risk. And in this case, you're hedging out the risk of being a freaking herb and gambling that money away, right? Because at least at the very worst, you will still have that investment account. And then you can be glad that you took the time, you set aside the capital to invest into a long-term account. And and 10 years is a long time for a person. They say we change every 7 years. So you could be a totally different person. You will be a totally different person after 10 years. Especially for the young people, gung ho. They're like, you know what? I'm gonna make it trading and blah blah blah. Okay, that's fine. It's great to have that aspiration, but at the same time, hedge yourself, hedge that inner demon that might pop up and try to take it all away, right? So I just want to throw that message out there. This is something I've been thinking about. Where could I have been? How much more could I have made if I just took a more hands-off approach? And I guess that kind of ties into like, how I'm approaching investing nowadays. It's more like just long-term. I find setups that are, you know, great for a long-term swing and invest into it and hold it. Don't care about the drawdowns. I embrace the volatility. It is what it is. And I'm not going to sit there and try to time the volatility because there's better things in life to enjoy than just to sit there and try to time the volatility and not try to be a part of the volatility, right? Because if I'm trying not to be a part of the volatility, I'm just giving up my time anyways. So, anyways, hopefully that was a cool message for some of y'all. Hopefully it hits a point for some of y'all. I touched on multiple things here, but yeah, that's about it. If you have any comments, just drop them below. I'll be, happy to chat with you. All right. Peace.